Right, so as Steph just talked us through, we know how much we think we hopefully can generate within retirement, how much we want to be able to have that fortnightly haircut if we want that. Otherwise, our wives might end up cutting our hair or vice versa, and I don't know who wants that, but now we're going to talk about how we can actually get to that level. For a couple, as Steph spoke about, that's 690,000, hopefully as a lump sum to be able to generate that comfortable lifestyle. So let's talk through a few ways that we can do that. Now you'll notice throughout this there are multiple ways of generating that lump sum. So it could be in your personal name. Some people do choose to do that. The ways that we're focusing on today will be about how to generate that lump sum within your superannuation fund. And the reasons for that are covered on this slide here. So as you can see on the first column, you've got your personal tax rate. So that's your marginal tax rate. Most of you who are working, the average tax rate is around 32.5% for most people. Within superannuation, your funds are taxed at 15% while it's in accumulation, while it's building up. That's obviously a pretty big difference straight up. If you've got any personal tax, any earnings on it, you've got that 690,000 invested, it could be getting taxed at 32.5%, in super at that 15%. And then when you eventually retire and we get to that pension account over here, we have this lovely zero figure. And that's what we all want to strive for. Everyone wants to pay less tax if it's possible, and this super pension environment allows us to do that. So that is why the strategies we're going to discuss on the next few slides will be all about generating it within super, building superannuation and not outside. There's 5 strategies that we're going to be covering today. There are more than 5. There's things as super spouse splitting, super contributions, things like that for spouses and splitting, but we're not going to go into that. We only do these 5. Superannuation is a very intricate area. There are a lot of different rules and regulations. Obviously, that keeps us in a job. The government's always changing the goalposts and changing things for us. So we're just going to try and cover the basics. As Steph said, we recommend that people come and talk to a financial advisor if you haven't before, because we can talk to you more about specifics for your situation rather than all the different things that might apply. We can just talk to you about what applies to you so it's less confusing. But the main things we'll be chatting about today is salary sacrifice, after-tax contributions, catch-up, concessional contributions, non-concessional and downsizer. So I'll start off with the fact that the laws have changed in such a way that you can't just go through life now and meet all your other expenses, get your kids off, get them through school, get your home loans paid off, do a bit of travel, and then all of a sudden go, oh, I want to retire in 5 years, let's chuck it all into superannuation now. Unfortunately, the government doesn't like us doing that, so they've put caps on the amount that we can get into superannuation. So this slide, it just covers what the caps are. It is in your pack for later on. It is covered on the next kind of strategies I'll discuss about, so I'm not going to go into it too much. But as you can see, you can put in 27,500 as a before tax contribution. So that's one that you can claim a tax deduction for. And then as an after tax contribution, you can do up to 110,000, or we can use 3 years worth of provisions and do 330,000 as well. And we'll talk through that a little bit more. The first thing that we saw on the slide was salary sacrifice. So this is one of the strategies that's used quite widely. Hands up if anyone's salary sacrificing at the moment. That's good. I'm glad I see quite a few hands up here. This is pleasing. This is what we want to see. Salary sacrificing is, as the name suggests, you're sacrificing some of your salary to put into superannuation to save for your retirement. So when you do that, it comes out of so you'll tell your employer, they'll set it up for you. It'll get paid straight into your super, and you'll see it on your payslip. It doesn't come to you at any stage. So it also takes out the temptation for some people. They see 10,000 build up in their bank account and they go, oh, I've got 10,000 here. That's really great. Let's go on this holiday, or let's buy this new TV, or let's do this. It takes that away from you as well. It's more forced savings as well, which helps. But there was also, once again, this tax effectiveness that we can see up here. So contributions, when you put them into super, as a salary sacrifice, you will have to pay 15% tax on that amount as it goes into superannuation. But if we remember, as we talked about before, the personal tax rate, if it had gone into your personal name and you've been taxed from your employer, then you could have been paying up around 32.5% on those same funds. So it's still a tax saving, even though you are paying tax going in. Now that annual cap, as you can see up here in the corner, that does include if you're employed on an employee basis your employer will be making mandated 11% contributions on your behalf to your super. That is included in that 27,500 cap. So that's your financial year cap. That is included in that, and that is something to be mindful of. And then underneath in that kind of blue box, we talk about the fact that some people might not be employed as an employee, you may be self-employed, you may just have a lump sum and be under 67 and want to contribute to super. You can do that via a personal deductible contribution. So same thing, you've got that lump sum, you talk to an advisor or talk to your super fund, they can give you the codes to put that into superannuation. And then once again, you can claim a tax deduction on that. So it reduces your taxable income from whatever you put in. That is another way of doing it. You can see up here though, as I said before, there's traps everywhere with this kind of stuff. It is a bit of a minefield. We can mention as much as we can, but you can contribute up to age 74 now, even if you're not working. However, you are still required to meet this work test, so 67 to 74, if you want to make that personal deductible contribution and claim a tax deduction. And another thing to mention as well is when you're claiming a tax deduction, you need to have taxable income to offset that against. Your taxable income is only $10,000 and you want to claim a tax deduction of $25,000, let's say. That's not going to work. You can only offset what you actually need to from that perspective. And when you do that, it then is counted as an after-tax contribution, so you can run into trouble with that. So once again, that's when we suggest you talk to a financial advisor to seek some more clarity about what works for your situation. This is just a little example of salary sacrifice. I've just done $50 per week for this one. Most people do choose to do more, but with cost of living and everything else going up at the moment, the best advice we give you is to start somewhere. So we've just looked at a base example of doing $50 per week. This particular person is earning $80,000 per annum, as we can see here. This line here, they're not salary sacrificing. This one here, they are. So if we look at the big difference, obviously down here, is you've got your different tax here. So they're salary sacrificing this, but they're paying less tax because of that 15% versus your marginal tax rate. That means at the end of the day, they're putting $50 into superannuation per week, but they're only going down $33 per week from the actual amount that goes into their pocket. So there's not that much of a loss. But the big bit here to look at is the net amount into super. So it increases by around 24%. So overall, you get a reduced, as you can see on the screen, you get the reduced take-home pay, you get a reduced tax payable, you get more into superannuation, and just for that $50 per week, it puts you in a position of, I think it was around $506 per annum better off. And as I said, that's a very basic situation, very base scenario. If you're looking at doing more than that, then that's obviously going to be a bigger, greater saving. If you look at that over a 5-year period with compounding interest, that's going to snowball and get bigger much quicker. But it's definitely something to start if you're not already, depending on your situation. Once again, that's something to chat to us about, but that's basically in a nutshell how it works. Is there any questions around any of that? Yeah?
Where did the 23.6% come from?
That was a different figure that got updated, but that bit on that slide didn't get fitted. It should be around 30%, I think it is now.
So where's that come from?
So that's just, that one figure here just wasn't updated on this slide because it was $30 per week and we've updated that and just forgotten that figure there. That's all. So that one figure was just not updated. I think it ended up being 30%, was it? Yeah, it was about 30%. It's just that one figure here didn't get updated when we updated the slide pack this morning. Oh, sorry. So it's increased. So if we look at down here, obviously net amount into super here was 7,480. On this side, it's 9,600. Then you look at the difference between these two, the extra amount into super, and then as a percentage of the overall amount. So that one wasn't. That was just the tax. Yes. You've got this amount here, obviously you're going in, then you've got your tax saving, and then that's how you know that extra growth goes into that. But yeah, that figure is wrong. It is around 30%. It was around that when it was at $30 per week, but we increased it and then that one just doesn't change. So it should be around 30 if you're trying to do the actual numbers when you go home. It'll be around 30, that figure there. Yes, exactly. Yeah, so it's that bottom bit down here. And as we say, that's only for a small amount, $50 per week. Most people do more than $50 per week. But as we say, you want to start somewhere. If your balance is below this magical number of 500,000, you can now do what we're calling catch-up concessional contribution, so from 2018. That does allow you to do more than that 27,500 as a tax-deductible contribution. So once again, super balance has to be below 500 for you, not as a couple, but just you personally, as long as that's the case. And you can change some stuff around, but as long as that's the case, then you can do this. So you can see on here, it's got to be able to through a rolling 5-year period. So you can see here, and this isn't a typo, this used to be the cap, the 25,000, and that's what counts still. This is the new one, so these are right. This particular person has put in either themselves personally or their employer, or together they've contributed a before tax, so a concessional contribution of $10,000 for the 5-year period. And that's all they've had surplus, that's all they're able to do. That then means the difference between the actual cap they had for each year and the unused amount that they haven't used equals here. So the first year, as you can see, it's just that flat 15,000. The next year, it actually ends up here. So we've gone here, they've still got 15,000 they didn't use, and it adds to this one before. And so you do that for that rolling 5-year period. And as you can see here, we end up with this really nice figure of 107,500. Now that's not going to be for everyone. Some years you might be able to, some you don't. But in this situation, there's then this figure. Now, apart from the fact that's fantastic because it means you can get 107,500 into super, and hopefully you've got that and can do that, and that's always fantastic. It also means that if you have capital gains tax asset somewhere out there that you know you're going to incur at some stage, so an investment property you might be looking to sell in a few years, or a big share portfolio, or something along those kind of lines that you know it's in your personal name, when you go to sell it, you're going to have a capital gains tax. It means you can, once again, you have to be under this 500,000, but it does mean that all of a sudden you can put this amount in and claim a tax deduction with it, which will help offset the tax payable on that capital gains tax asset when you dispose of it. So it does mean you've got extra strategies like that available to you as well. Now, I know that's a lot of information at once, so like I said, ask questions will be around at the end. That is what we're here for, though. That's the kind of things that we're looking at. We try and look at assets, what we want to do over the next 5-10 years, and structure things out in such a way that we can make all of this stuff work, so that your money is working really hard for you and it's doing the most it can on its own, so that you guys can retire a bit earlier. After tax contributions, the others were all pre-tax. This is after tax. You put it into superannuation after you've already been paid the income, you've already paid tax on it in your personal name. You then can put it into superannuation. It is a larger amount that you can put in. As you can see, you can put in up to 110,000 each, or we can use 3 years worth of that level and do 330,000. But then you can't do anything for that 3-year period afterwards. So if you did dispose of a big asset like the home, like an investment property like we were talking about earlier, you could then put all of those proceeds into superannuation as an after-tax contribution. Now, the advantage of doing something like this is, one, you get all those funds into super. 2, anything that goes in as an after-tax contribution goes into your super as a tax-free component of that superannuation. So within your accumulation accounts, you will have a taxable portion and a tax-free portion. And that taxable portion is made up of your salary sacrifice contributions, your employer mandated contributions, those personal deductible, any of those before tax contributions we were talking about before. What that means is when it passes to your spouse, it normally just passes along tax-free, where most people then leave it to their adult children who are non-tax dependents, and it's then taxed at 17% on that taxable portion of your super. Most people's super is made up of those pre-tax contributions. So most people's made up of your employer contributions and things. Let's say 80% of your super balance, when it passes to your adult children, they could potentially pay 17% tax on it. There are ways that we can structure things. There are strategies we can do to minimise that amount that is in your super as a taxable portion, make it tax-free. We can play with some things and massage some strategies to help out so the kids don't pay that. And once again, that's what we're here for. It's quite complicated to go into in a 1-hour session, so we won't. But ask us, come and see us for that meeting, and we can talk through those kind of strategies if that sounds like something that you would like assistance with, so that your kids aren't having to pay as much tax on your hard-earned money. Another thing underneath that you'd see here is we've talked about government co-contributions. If you are earning, and this magical numbers here, if you earn less than 43,445, And so then you get, if you put in $1,000, the government will match it 50 cents to the dollar. So if you put in $1,000 as an after-tax contribution, so a non-concessional contribution, the government will match that and put in $500 if you earn under this magical number here. If you earn over this number, they won't put in anything, and if it's between, then it's on a sliding scale. So it's just another kind of bonus that you can get if you find that you're under that, or your kids are, your young kids or something. If they put in $1,000 a year, government gives them $500. It's just another kind of thing to be mindful of. And you'll notice that when I was talking about contributing lump sums into super earlier, I was talking about investment properties and share portfolios, things like that. I didn't actually mention the residential house at any stage. That is, as you can see on the screen, because we now have a thing called a downsizer contribution to super. Has anyone here heard of that before or utilised it? Yep. There's a few people that put up their hands. There are restrictions on it, so as you can see here, you must be over the age of 55. You have to have owned the home for 10 plus years and a few other things that I won't go through because it's on the screen for you. But basically what it means is if you sell your primary residence, you can put in up to $300,000 yourselves and the same for your partner as well, of the sale proceeds into your superannuation. Now it doesn't count towards those caps that we were talking about earlier, so it doesn't count towards that non-concessional cap, which means you can basically just get that extra amount into superannuation. So it's just another way that you can get lump sums into superannuation quickly as you approach that end of your retirement period.
Is there a time limit on that?
It's within 90 days, so there is that as well. And you can only claim it once as well, which is another thing to be mindful of. So sometimes if people have the residential home and they've also got an investment property and they know they're going to move to that investment property at some stage and turn it into the residential home and it's worth more, you can have that discussion about whether or not it's worthwhile claiming it on that first house when they sell it or on that second house if they've met the requirements and had it for more than 10 years and things as well. Any other questions on that? So I've covered how to build your super in a few ways. As I said, there's a lot more than what we've gone through. Mindful of the time, Lee's going to say what we can do once we get there.